walk into any casino in Las Vegas, and the house knows something you don't. The math is on their side. In the world of Forex, the house is the market itself, and the statistics are even more lopsided. You've probably heard the 90-90-90 rule. 90% of new traders lose 90% of their money in the first 90 days. It's a brutal reality check. But here's the kicker. The market isn't actually rigged against you in the way a slot machine is. The market is just a giant mirror of human emotion. Today, we're going beyond the surface. We aren't just listing mistakes. We are dissecting the psychological and mechanical failures that lead to the great wipeout. If you want to stop being a statistic and start being a professional, you need to understand these 10 reasons why most traders go bust. 1. The get-rich-quick delusion. The first reason is a marketing problem. If you search Forex on social media, you see 20-year-olds in Dubai leaning on rented Lamborghinis, claiming they turned $500 into $50,000 in a week. This creates the casino mindset. The problem: beginners approach Forex as a lottery, not a profession. They look for the one big trade that will change their lives. The science: this triggers a dopamine response similar to gambling. When you trade for excitement, you make impulsive decisions. The reality: professional trading is inherently boring. It's about repetitive execution of a proven edge. Pro tip: if your heart is racing when you click buy, your position size is too big, or your expectations are too high. 2. The weapon of mass destruction. Excessive leverage. Leverage is the reason Forex is so popular, and it's the exact reason most people die in it. Brokers offer 1 to 100, 1 to 500, or even 1 to 1,000 leverage. It sounds like a superpower, but it's actually a trap for the uneducated. The math: if you are using 1 to 500 leverage, a tiny 0.2% move against you can wipe out your entire margin. The trap: beginners see leverage as a way to grow a small account quickly. Professionals see leverage as a tool to be used sparingly to manage capital efficiency. The solution: treat leverage like a sharp scalpel. In the hands of a surgeon, it saves lives. In the hands of a child, it's a disaster. Most pros rarely use more than 1 to 10 effective leverage. 3. The absence of a true trading plan. Most traders wing it. They wake up, look at a chart, feel like the euro is too low, and hit buy. That isn't trading. That's an opinion. And the market doesn't care about your opinion. The anatomy of a plan. A real plan must define: 1. Entry criteria. What exact price action/indicator setup must occur? 2. Exit strategy. Where do I take profit? 3. Invalidation. Point. Where's my stop loss? 4. Risk per trade. Exactly how much of my balance am I losing if I'm wrong? The mistake: changing your strategy every time you have 2 losing trades in a row. Strategy hopping. The fix: a trading plan is your business contract with yourself. If it's not written down, it doesn't exist. 4. Catastrophic risk management. This is the account killer. Most traders focus 90% of their time on where to enter and 0% on how much to risk. The analysis: if you risk 10% per trade, a normal bad week of 6 losing trades ends your career. If you risk 1%, you are still in the game. The gambler's ruin. Once you lose 50% of your account, you need a 100% gain just to get back to break even. The math of recovery is much harder than the math of loss. 5. The amygdala hijack. Revenge trading. When you lose money, your brain enters a fight-or-flight state. This is the amygdala hijack. You feel a physical need to get back what the market stole from you. The cycle: you lose $100, you get angry, You double your position size to win it back fast. The market moves against you. You lose $300. The ego trap, revenge, trading is fueled by the need to be right. The solution. The market isn't a person. It didn't take your money. You gave it away by not following your rules. After a loss, step away from the screen for at least 2 hours. 6. FOMO and the late entry. Trap. Fear of missing out is a powerful drug. You see a massive candle surging upward, and you think, I'm missing the big move. The reality. By the time a move looks obvious on a chart, it's usually over. The big players, banks, are already looking to exit their positions into the retail liquidity, which is you buying at the top. The discipline. If you miss the entry, you miss the trade. There will be another setup tomorrow. The market is like a bus. If you miss one, wait for the next. Don't try to chase it down the highway. 7. Moving the goalposts. Mismanaging stop losses. This is a psychological illness in trading. Moving your stop loss further away because you believe the price will turn around. The fallacy. You hope that by giving the trade more room, you avoid a loss. In reality, you are just turning a small, controlled loss into a massive, account-ending disaster. The pro view. A stop loss is a mathematical point where your trade idea is proven wrong. If the price hits it, the idea is dead. Bury it and move on. 8. The silent killer. Overtrading. Traders often confuse activity with productivity. They feel that if they aren't in a trade, they aren't working. The hidden costs. Every trade has a spread and a commission. If you take 20 scalp trades a day with a low win rate, your broker is the only one getting rich. Market conditions. The market only trends about 20% of the time. The other 80% is noise. Most traders lose all their money trying to trade the noise. The wisdom. Sometimes the most profitable thing you can do is keep your hands in your pockets. 9. Failure to keep a trading journal. If you asked a failing trader, what is your average win rate over the last 50 trades? Or, what is your best performing currency pair? They wouldn't know. They are flying blind. The importance. You cannot improve what you do not measure. A journal reveals your patterns, like the fact that you always lose money on Fridays, or that you struggle with GBP/JPY. The requirement. A professional trader is a data scientist. If you don't have a journal, you're just a hobbyist with an expensive habit. 10. The Holy Grail search. Finally, the 10th reason, searching for the perfect indicator. Traders spend years looking for the magic combination of RSI, MACD, and Bollinger Bands that never loses. The truth. There is no Holy Grail. Every system has a drawdown period. The secret. Success comes from mastering one simple strategy and having the discipline to stick with it through the losing streaks. Conclusion. How to join the 10%. The reason 90% of traders fail isn't that trading is too hard. It's that human nature is poorly suited for the market. To succeed, you have to trade against your instincts. You have to love small losses, be patient during boredom, and stay humble during winning streaks. If you can master your mind, the money will follow. Which of these 10 mistakes are you currently making? Be honest with yourself in the comments below.